Hello students. So today we are starting with the third unit, that is evaluation of securities. In that we are going to deal with the first subtopic, that is bond. So we'll study what is bond, features of bonds and types of bonds. So let's begin. So what is exactly bond is? So bond is a long-term contract under which a borrower agrees to make payments of interest and principal on specific date to the holders of the bond. So if you see here, the most important part is it's a long-term contract. Okay. So where the borrower is agreeing to make payments, okay, that is interest and principal on specific date to the holders of the bond. So if you see here, the important part is it's a long-term contract where a borrower is agree to make payment of the both interest and principal, and the date is specifically mentioned, and he is paying it to the holder of the bond. Now let's see the definition. It is a written and signed promise. So two important things, written and signed promise to pay a certain sum of money on a certain date, that we have already seen in the earlier definition, certain date or on fulfillment of a specified condition. So if there are any condition which is written in the document or so bond agreement, so if it fulfilled, so that is a money should be written on that time. So all documented contracts and loan agreements are called bonds. So we'll come to know that it's a debt instrument and it's a long-term contract. So here is the agreement between the bondholder and the borrower regarding payment of interest and principal, either specific date or the fulfillment of specified condition. So now let's go to the features of bond. So some more thing about the bond before going to the features. So if we just go in detail with it, a bond is a contract that requires the borrower to pay interest income to the lender. Okay, there will that we have already seen. It resembles the promissory note and issued by the government and corporate. The par value of the bond indicates the face value. Okay, so face value of the bond, that is the value stated on the bond paper. So generally face values of bonds are 1,000, 2,000 and 5,000 and alike. And coming to the next, most of the bonds make fixed interest payment till the maturity period. Okay, and this specific rate of interest is known as coupon rate. So this is important one. So what is coupon rate? So coupon rate is the fixed interest payment which is received by the lender of the money or a purchaser of the bond or a bond holder. So coupons are paid quarterly, depends, semi-annually and annually at the end of the maturity period. So the value is repaid. So at the end of the maturity period, the value of the all stock will be given. Now let's move the features of the bond. So first feature of the bond is par value. So par value we already know, and you know it what exactly par value is. It's the stated face value of a bond, which is mentioned in the bond, which is written. Okay, next comes the coupon interest rate. So the fixed rate of interest, which remains the same throughout the life of the bond, and that is also mentioned in the bond. Next comes the maturity date. So here the specified maturity date on which par value must be paid. So a date, most of the times date will be fixed. So this is the date of maturity of the bond, and where the par value, if interest is not paid, so interest plus par value will be paid at the maturity period of the bond. Next is a call option. It gives the issuer the opportunity to repurchase the bonds prior to maturity. So that can be also done by the borrower of the money. Okay, or you can say issuer of the bond. Now let's see the types of bond. So first one, zero coupon bonds. So the issue price of zero coupon bonds is inversely related to their maturity period. So these two are important here. So that is longer the maturity period, lesser would be the issue price, and vice versa. So these types of bonds are also known as deep discount bonds. We call them deep discount bonds. Now next comes to the floating rate bonds. Floating rate notes are bonds in which interest rate depends on the interest rate prevailing in the market. Okay, they always changes. There are no fixed interest rates. So the interest rate paid to the holders, bondholders at regular intervals comprises of the interest rate prevailing in the market and the spread, which is a rate that is fixed when the prices of the bonds are being fixed and it remains constant till the maturity period of the bond. Okay, so that is the second type of bond that is called floating rate bond. The next is perpetual bond. So these type of bonds known with the name of console, and these bonds have no maturity period and keep on paying interest to the investors regularly. Okay, so there will be no maturity period and there will be no date mentioned. So the issuer of perpetual bonds is not required to redeem these bonds. They are generally treated as equity and not as loan or debt. Okay, not as loan as or debt. So next is convertible bonds. So these bonds has the option to convert the bond into equity after some period of time as the same value of the bond of the issuing firm on a pre-specified terms. So terms will be mentioned with the borrower wants, so they can convert. These convertible bond can be converted into equity shares up after certain period of time. So convertible bonds may be fully or partially convertible. For the part of the convertible bond which is redeemed, the investor receives equity share and the non-converted part remains as the bond. For example, if it is 1,000 rupees bond, so 500 will be converted into equity and remaining 500 will be remained as the bond value. Next is high yield bond. So these are non-investment grades. So high yield bonds are found issuers that are considered to be at great risk of not paying interest and or returning principal at maturity. So as a result, the issuer will offer a higher yield than a similar bond of a higher credit rating and typically a higher coupon rate to entice investor to take on the added risk. So these are such companies where they are not having good credit rating with them. So they to attract, they offer a high rate of return with the added risk. Next are corporate bonds. So these are issued by large corporations and have higher yield because there is a higher risk of a company defaulting as compared to government bonds. So they are basically issued by the corporates and they are obviously higher yield, and because the corporates is always risky. Okay. Next is government bonds. So these are the risk-free bonds we call. These are the bonds issued by the government, okay, in its own currency. They are usually referred to as risk-free bonds. That these, because it's an issued by government, means there is no risk. So bonds issued by national government in foreign currency are referred as a sovereign bonds. So next comes inflation indexed bond. So these bonds provide protection against the inflation or money value decreases, then these type of bonds supports. If there is an inflation in the market or economy, so this type of bonds helps to tackle the inflation and is designed to cut out the inflation risk of an investment. So next comes the extendable and retractable bonds. So these bonds have no maturity dates. So while the maturity period of extendable bonds can be extended on the demand of the buyer of these bonds. If they want to extend, they can extend. And the maturity period of retractable bond can be reduced and the principal amount returned to the buyer if he feels so. So one is extendable, anything it can be extended, and retractable that can be reduce the time of redemption. Next comes the treasury bonds. So T bonds also. So these are marketable bond, fixed interest rate, US government debt security with a maturity of more than 10 years. So treasury bonds makes interest payment semi-annually and the income that holders receive is only taxed at the federal level. Next comes municipal bonds. So these are the one of again famous bonds. So these are debt security issued by a state government or municipality or county to finance its capital expenditures to meet it to meet the immediate requirement of the capital expenditure. So municipal bonds are exempt from federal taxes and from most state and local taxes, especially if you live in the state in which the bond is issued. Last one comes the foreign bond. So this type of bond is that issued in a domestic market by a foreign entity, okay, in the domestic market's currency. So a foreign bond is most often issued by foreign firm to raise capital in a domestic market that would be most interested in purchasing the firm's debt. Okay, and for foreign firms doing a large amount of business in the domestic market, issuing foreign bonds is a common practice. So types of foreign bonds include bulldog bonds and matilda. So these are the famous bonds which are foreign, which a foreign country issues the bonds in the domestic country. So this is the end of the types of